Hey guys, welcome back to another episode of The Educated Homebuyer. This is where Josh and I answer your questions, update you on the economy, tell you how high interest rates are, and that they're never coming down. Josh,
And
welcome back to the show.
thanks. Thanks for that intro. Thanks for the reminder of how joyous the last 60 days have been. And yeah, we'll go from there.
Yeah, so this past week, really, I mean, you get data coming out, you get different things happening in the market, but really the story is higher rates on top of Fed officials coming out in more or less saying that, one Fed official, more so than others, Kashkari, basically saying that rates need to go higher, that they don't feel like it's actually doing what it should be doing with regards to inflation, which you and I think he's crazy, but nevertheless, that's what's happening. Rates are pushing up. Tomorrow we have jobless claims. We got pending home sales. Friday's PCE. So Friday's a big day in the market. But the reality is we've broken 4.5. We've broken 4.6 now. The support above or the resistance, however you want to look at the chart, isn't looking good for the 10-year, which likely means higher rates to come. What are your thoughts on that,
Yeah.
Josh?
Well, we just saw a nice little headline, and we talk about being careful of listening to the media. But the Forbes headline says today we hit a major sell signal for bonds, which selling would mean higher interest rates. And basically, what their point is that from 1980 to 2022, we had a 42-year bull market in interest rates. Interest rates didn't go in a straight line down, but they did nothing but improve over any 3-year period or so over those 42 years. So we've hit a 38.2% fall, below a 38.2% retracement from the top, which is generally a very strong sell signal. We've talked about technicals being voodoo before, so now we're telling you all about technicals. So we are hoping tonight that it's 100% voodoo and not accurate, but technically nothing looks good for the bond market right now. Jeb, we did that episode of the podcast 3-4 weeks ago, our rate's going to 8%, and both of us said possibly, but not likely. Now, asking me today, I would say probably is the answer. I don't know what I was going to say, but probably is probably the answer.
You know what's funny is I created this episode, this stream, I think Thursday or Friday of last week, and put it up to be scheduled to be live today, right? So I kind of planned in advance, and at the time, I labeled the title of the video. It was "Buckle Up." What does it say? The Fed is ignoring the obvious, and my God, it couldn't have been more true. It was like predicting what was going to happen this week before we get all these remarks and stuff out. So we're going to talk about it in more detail. We're going to answer your questions. We're going to take a look at some economic data as well as inventory, what's going on in the housing market, as we normally do with some charts. So that, Josh, that's where we're going to start. And as we always do, we're going to take a look at inventory. So we saw a tick up in inventory to 527,938 homes. So I think it was about 9,000 homes from where we were last week. So something to note here. This is typically a time in the year where you're not seeing upticks in inventory. That said, interest rates are higher, which means less buyer demand, muted buyer demand, therefore less properties coming off the market. It's not necessarily more properties coming on the market. It's just less coming off. And therefore inventory is building. And so we're going to see that here in the new inventory chart in just a minute. But Orange County sitting lower than we were last week by about 50 homes, 2285. Huntington Beach, about where we were last week. I think we're down 1 home. So inventory here, more or less flat week over week. We're not seeing any big increases. People are still buying homes. Things are still going. I have an investment property on the market right now that requires a cash offer. My phone has been blowing up today from investors looking to buy that home. Now, it's a cash purchase, so rates aren't really affecting their ability in many cases because they're buying it cash. But, it just shows you the demand at certain price points out there still looking to buy. So new listings in the market, as you can see, new listings ticked down, but yet we still saw that increase in inventory week over week. And it's primarily because homes are sitting a little bit longer. Inventory, again, this is about the time of the year where you would start to see that peak and see things roll over. The next couple of weeks, 3 to 4 weeks, if rates continue to go up, stay high, inventory is going to continue to build. in a time of the year when it wouldn't normally build. A lot like last year, Josh. November last year, October last year, we saw that peak in rates. Is this the peak that we saw last year, and then we start to see it tail off? I don't know, but as we said, the data is not looking solid at the
I
moment for that
agree
to
with
happen.
you 100% from the demand side. If rates go any higher, if rates stay at this level, it will continue to decrease demand. My wonder or my question is, the person who put their home on the market thinking they were going to go buy at 7%, they might take their home off the market when they realize they're going to buy at 8%, 7.75%, because most sellers are net buyers. They don't sell to rent. I mean,
Right.
there are some out there that are selling investment properties or selling to move to a cheaper state with family, whatever. But definitely will be some supply destruction there as well.
No, agreed. And yeah, it's hard to look at 1 week and tell you that's a trend, right? So we're kind of monitoring this over weeks. So last week we saw an uptick in inventory. This week we saw another uptick. It's still not big numbers, but they are increasing week over week when we had seen some decreases. So we'll continue to watch it, continue to update you and keep you in the loop. Pending sales. So this is what we're talking about. Less properties going under contract, 14% fewer than last year. And then that's on the new pending sale side, and then total pending sales down about 12%. So again, less demand out there in the market because of rates. So we went from 518 to 527 on inventory. Same week last year, 552 to 556. So we're still below where we were last year, but rates stay high. There's a really good chance that we could see numbers higher than we saw last year with regards to inventory. Median price of homes that are newly in contract, current sales price just below last year, sitting at 370. And last year we saw this spike in rates sometime around September. This year it's again happening in September. It happened before, but we're seeing another spike right now. Percentage of properties decreased on the market, sitting about 38% of properties out there had some sort of decrease, which essentially goes in line with the chart here showing 37% of properties out there have some sort of price reduction. That will trend up is if inventory continues to grow because of high rates, muted demand, low buyer demand. More and more people, if they have to sell, are going to have to do something different in order to get their property sold. Because it is affecting affordability. It's affecting everything. And, if demand, the only way you don't see price cuts is if you see something change on the rate side, which again, isn't likely to be significant anytime soon. Josh, this is a chart basically showing the last six, I guess this isn't recessions. This is what we saw, inflation episodes.
Inflationary periods.
Yeah, inflationary periods. And how essentially the idea behind this chart was that every time inflation comes and goes away, it always comes back. So what are your thoughts on this, Josh?
I take it with a grain of salt, because look at everything post 1982. Once that Fed broke the back of inflation, Volcker raised rates to the moon, slowed the economy, put us into recession, and slowly inflation got under control. Yeah, we've had these little rebounds since then, but probably the biggest thing from the last 45 years is really what we're talking about, 45 years. You'll see this in a slide here in a second, Jeb. There's a big transition that we were a manufacturing economy at that time. So we were subject to oil shocks, any number of things. So things outside of our control, there's always going to be extrinsic factors that our government, that our economy cannot dictate and control on its own, but we are far less susceptible to them as a service-based economy than we were as a manufacturing-based economy. Is it something to be aware of? Is it something to watch? Absolutely. I think our Fed is so petrified of things that happened 40, 50, 60 years ago that they're going to ensure that it never happens by making the economy run into a brick wall.
There you go. Which takes us into this chart, basically showing what, the 70s, if you will, what was happening in the 70s with, the Fed funds rate, inflation.
So if we look at that, go back, that blue line there is inflation, back somewhere between 57 and 61. So about 1959, there was basically a pretty consistent trend up. This stops right in the early 80s when inflation was under control. So that was a long-term trend of inflation increasing. And yes, we had 73, 74, where we had a bout of inflation, got it under control, and then back again in the early 80s. Again, those were extrinsic factors. Could you say that we have an issue of oil? Yes, but we're far less dependent on foreign oil than we were, even though we're far more dependent on foreign oil than we need to be. I don't want to get Wesley upset if he's here and watching, but our government has made it very clear that they are disincentivizing investment in our own production. Someone that I know and trust and respect greatly heard someone say this and attacked them, said that's insane. Oil prices, energy prices are up around the world, and that is correct. The difference is most nations, unlike the United States, do not have their own oil resources that they could insulate themselves from that shock with. We have it. We've chosen not to utilize it over the last 4 or 5 years relative to what the prior administration had done. And we've been trending in that direction over time. And really what it comes down to is when you make it clear that an investment in oil production that requires 15, 20 years to pay off, that policy over the next 15, 20 years is likely to try and kill off your industry, it is hard to get capital. It's hard to get capital for any business right now at current interest rates. Very hard to get capital to invest in the oil industry when you have a very uncertain future of what our government's going to allow. This, Jeb, is the chart I was talking about. We're currently at 22.4% manufacturing, 77.6 services. So you can almost flip that when we go back to all those times in that chart where we were seeing these boomerangs in inflation. So from that perspective, is it something worth keeping an eye on, something being aware of? Yes. Is it something that I think there's some rule where there's always a rebound bout of inflation? No, I don't tend to agree.
No, good stuff. And those of you, again, we say this every week, but those of you listening on the podcast don't have the visuals, want to see the visuals. Maybe you're even on YouTube, want to go back and look at the stuff later. Just look at the charts. I am updating the description as we speak to include that link. So that link will be posted in the description there. It'll be on the podcast when you listen to it. Just go down to the show notes, and you'll see that link if you want to take a look at those charts that we're referencing here. So Josh, this goes back to the 20-year treasury bond, sitting at what, the lowest level that we've seen since 2011.
Yeah, so this isn't the 20-year; it's the ETF of generally 20 plus years. So it's a long-term treasury yield ETF, and that's the lowest since 2011. And we let off the show, if you showed up here late by a few minutes, that we've hit a really critical level on basically any bond index that you want to look at. And technically, if it gets worse, we're going to see at least another, I wouldn't call it a small jump, but another jump in interest rates to a new level. We will see where that goes over the long haul. Yields are dependent on what happens with inflation. We are on record here of saying we think inflation is controlled. Doesn't mean prices are going to get rolled back and we're going to see deflation, but inflation is moderating back to that 2% level that the Fed would like to see. It could take another year. It could take another 2 years, but we are working our way back to that. So this is a really interesting chart, Jeb, decomposing bond yields. So basically, it tells you what investors are looking for in those yields. So the blue is the term premium. So term premium means the longer you'll tie up your money, the more of a return you're going to get. If you loan someone your money for 30 years, you want a bigger return than if you loan it to them for 30 days. So we're seeing the upside or the flip side of that in that we have yield curve inversion. So there's not a premium. There's a discount for duration there. So inflation expectations, if we look at that, the orange bars there, inflation expectations, nothing much has changed. So investors who invest with real money buying bonds don't see much of a difference. So where is the difference? It's real growth expectations. So they're expecting growth going forward in the economy on top of inflation, and they're discounting for term premium. So if we look at the next one, Jeb, I think the next few kind of go and tell a story. So real GDP expectations. So this just pulls out of that last chart what the bond market is telling you they expect for GDP growth. So for 2023, they expect 2.5% GDP growth. Now, we don't know what yields are going to be in the first quarter of next year and the fourth quarter of next year, but it had better come down fairly quickly or continue to see rates that high. So if we roll over to the next one, this is just a long-term trend that shows you real numbers. That orange line is just a trend line fitted to the actual real movement. And it's saying that over the next 10 years, we're likely to see growth of 1.65% annually in terms of GDP. Now, this is from our friends over at the Fed with their announcement and press conference last week. This is the data that they put out. So that's 2023, 2024, and 2025. So at this point, we're almost to the end of 2023. So
Crazy.
it doesn't take much of a crystal ball here to project this. So you saw the market is expecting 2.5, 2.6%. The Fed themselves saying for 2023, first of all, that dotted blue line over to the left is where they started the year, and where they were in June, just 3 months ago, and then now to the right is where they moved. So they have expected more growth. So again, 2023 is that cake is almost baked right now. So not much to quibble with there. But if we go forward to 2024, they're saying they worry about a strong economy and that they're not having the impacts they want. But watch how far this moves back to the left. Now we've got the majority of those bars, if we add them up, at 1.5% or lower. So if you say we go from 2.6% growth expectation for the bond market to 1.5 next year, you have 10-year yields 1% lower than where they are. Possibly not. If the yield curve normalizes, you then do build that term premium back in. So say you go from a negative to a positive, it's less. But the crazy one to me, Jeb, is magically they think by 2025, we recover again and are back experiencing growth almost as good as what we're going to see here throughout 2023. I think that's insane. I think they are absolutely insane. 2024 is going to be worse than this. We talked about before, recession is typically defined, although we changed the definition because we had 2 consecutive quarters last year of negative growth. But just look at that real quick. If you're saying 2024, they're saying a few of them are saying it gets down to 0. If we see a recession next year, that's going negative. And if it goes negative for 2 consecutive quarters next year, we're not going to be seeing 2% positive growth in 2025. So I think the Fed is either purposely misleading everyone to make sure that the bond market doesn't front run future decreases to federal funds, future decreases in inflation. So we'll see. We're going to find out over the next 6 months. This one, Jeb, we talk a lot here on the show about how the government spends too much money and lives off the credit card. This is household income. So household debt per capita is the blue body of it, and then the orange bar is personal income per capita. So that runs up through, the top one runs up through 1980. And you could see that we had more income than debt per person in the United States. We crossed over, I think, somewhere in the 80s where it's varied over time. The big peak of that blue body in the bottom chart was 2008, where households became most over leveraged. And you're seeing we are trending back up in that direction. So we as a country are over indebted. We as households are over indebted. Those things lead to lower growth over time. Households that are over leveraged have less ability to spend. There are certain things that are not discretionary. You're going to find a way to get food. You're going to find a way to get shelter. But it's kind of absurd to look at this chart and think that spending can go on indefinitely, and we're going to have this wonderful market. So, Jeb, we're expecting our next read on inflation. We've talked about PCE is coming Friday. It is the Fed's preferred measure of inflation, but it has taken a backseat to CPI over the last year or so. But what we're going to see is a repeat of what we saw with CPI 2-3 weeks ago. The market consensus is for headline inflation, so which includes food and energy, to increase from 3.3 to 3.5. So just get ready on Friday. You will see headlines that inflation continues to trend out of control. The core, which again is what the Fed looks more closely at, strip out food and energy, there is a chance that we see a 3 handle on it. It drops from 4.2 to 3.9. The rest of the text on there just says that the Cleveland Fed puts out their projections. They think it's going to go from 4.2 to 4. The 4.2 to 3.9 is the general market consensus right now. So it'll be interesting to see if we get under 4% on the core, if that has any impact on the market on Friday. You want to talk through this fun little chart here, Jeb?
No, not really. I mean, again, we're just talking about, economy slowing, people spending less money in the economy on discretionary things that push up inflation. This chart kind of goes hand in hand with that. Look, housing payment as a percentage of median income sitting at the highest levels we've seen, higher than we were this time last year, higher than we were during the housing bubble crash, whatever. back in 07, 08. Just shows you less money out there going towards, the things that push up inflation, on top of, money supply basically coming down, less money out there. It leads to slower growth in the economy. Again, goes hand in hand with, what the Fed is doing. And I don't know, shows me that things are slowing, continuing to slow. And I'm not a genius, so I don't know how the Fed is missing, you know, the
Well,
writing on the wall.
all of the things we talked about before, Jeb, relate to the velocity of money. So growth is money supply times the velocity of that moving around your economy. So we see the biggest decrease coming off the biggest increase in history of money supply, now the biggest decrease of money supply. And in the short run, the velocity was fairly high as households had flush balance sheets. That money was flying around. Someone goes and buys an iPod. Someone then goes.
Did you say an iPod?
We don't have those anymore.
Who buys an iPod?
An iPad.
I will give you an iPod. If you want an iPod, don't even buy one. Just text me and I will send you one. I'm pretty sure I have one laying around my house
don't
that I
make
could
fun
not
of us
give away.
Boomers. With that, but the velocity is absolutely decreasing as household budgets, there's more debt, less savings. So we've now got to the part of the show where I wanted to let you know that it is not all doom and gloom. All is not lost. So this actually compares what people have spent over time from 1901 to 2022 on different expenses. So we are here to talk about housing. Housing has been incredibly consistent at plus or minus 25% of household incomes. That's where we're at right now, unless you go back to Jeb's previous chart and you're buying a house and you're spending 48% of your household income to qualify. Food is much cheaper than it has been. Transportation is a little bit more expensive. Entertainment, apparel, healthcare, all of that fairly consistent over the last 100 years, all while ignoring that we're not controlling there for quality. Our cars, our houses, our healthcare, everything is 1,000 times better than it was, and generally we pay the same price for it. So remember, we are lucky to live in this wonderful day and age.
There you go. Lizzie would like an iPod. So Lizzie, I'm pretty sure I have one somewhere. I'm not sure if it works. I definitely don't have a charger for it, but I have an iPod. I can send it to you. That said, guys, appreciate you bearing with us for 22 minutes to go over kind of what's happening in the economy, give you a little update there, what is expected this week. Hopefully how, next week we'll talk about how that plays out in real time, or not real time, in reality, right? What happened with PCE and different things and how it affected rates. Hopefully by next week, rates have moderated some. I told Josh today, it almost looks like, a push, like the final push of the 10-year going high, right? Like almost like the everybody just loading in and giving that one final thing before things reverse. Probably not going to happen, but that's what I want to feel. So that's what I'm saying. But here, this last week on the Educated Homebuyer podcast YouTube channel, separate from this channel. If you don't know about it, go check it out, like, subscribe, listen to it. We talk about home equity lines. If you own a property now, I realize a lot of you are trying to be first-time home buyers, but there are people out there that are first-time home buyers that own property rather, that are looking to pull equity out. Go check it out and listen to it. If you have questions, maybe you're somebody who has a parent that has the ability to pull some cash out to help you buy a home. It's a really good episode to check out, listen to, because it kind of goes over your options, what people are thinking, kind of a deep dive into that subject, something we really don't talk about a lot here. So anyhow, check it out and we'll go from there. Clearly got, the trolls are out, Josh. The trolls are out. Here we go.
It's amazing they don't have anything to entertain themselves with other than two goofballs talking to a camera.
And how they haven't bought a house yet. It's amazing, right? It's amazing.
Most of them, Jeb, will tell us they own 2 to 3 free and clear.
Yeah.
Most of them, that's the story that they have.
Logical thinker. As the U.S. continues to recklessly spend further into debt, really big statement there, very true statement. The bond market continues to be flooded with treasury supply to cover deficit spending. Do you think this will continue to drive rates higher, Josh?
It's not the only reason why rates have gone higher, but is definitely a reason. So historically, the argument has been that debt spending, deficit spending is inflationary because you have to find people willing to fund this debt. So over all of a recorded history, we have been, the United States government debt has been the safest bet that someone could make. So if you have dollars that you need to park, you park them in US Treasury. So it has never been a problem. Despite ever increasing debt over the last 50, 60, 70, 80 years, it has yet to be a problem. So what we've shown that in terms of the other components of interest rates, inflation is moderated by deficit spending because it pulls money away from productive purposes and shovels it towards just debt service. So a secondary piece of it is we will hit a wall really quickly. I'm sure you guys saw the headline this week. We've hit $33 trillion in federal debt for the first time. For those of you who are young and don't watch this stuff, I believe when Obama came into office, right before all of the spending for the Great Recession and all of those programs that needed to be paid for, it was about 7 trillion. So we're going on 500x growth in what he came into office in 2008. So 15 years, 20 or 5x and $26 trillion of federal debt. So there's no positive spin on it. There's nothing that you can say that's good about it. Even if it led to lower inflation, it's because you have lower growth. I think we all would be happy with 7% interest rates if we had, 5, 6, 7% annual increases in wages and such. So it's sort of a balance. You don't want this low growth, low interest rate that we've had because it generally means low wages and other things are not sort of keeping up and keeping pace. But probably above my pay grade, but I can tell you that the academic research says no, it doesn't lead to higher rates over the long haul, but in the short run, it absolutely is playing a role.
No, agree. So SK makes a statement saying the housing crash is here. So I don't disagree with that statement in the sense that the number of transactions is going to continue to go lower. Which call that a crash, call it what you want, but it is less transactions out there in the economy, less transactions happening compared to where we were last year, year before. Crash, whatever your definition of a crash is, it's lower. The problem, quite frankly, is that it doesn't affect home prices in a meaningful way for those people that are sitting on the sidelines. And I think, as someone who owns a property, buying another, whatever, I don't care so much about I do care about the number of transactions. It's important, but I would like to see more people be able to buy homes. And so it's the number of transactions crashing doesn't necessarily improve affordability. And that's where you need to see things improve. And that happens with more supply, that happens with more rates, that happens with sellers having to reduce prices to a point where there's some trickle effect to other potential homeowners in that marketplace where prices come down. And the problem is that you don't have that. And problem, good or bad, depends on which side you're on. If you're a homeowner, it's a good thing, right? Because it provides stability. If you're a would-be homeowner, it's not so good because it is on the other side. It doesn't really provide any relief. And I think that is where we're kind of in this conundrum for I don't know how long. It is a problem, and there's not an easy solution. Josh?
Yeah.
Yeah.
No, that what no one saying that on that side of the screen is saying housing crash in terms of a crash in volume. We've absolutely seen a crash in sales volume. They're saying that a housing crash in prices is coming. And my face is going to turn blue. Tell me why people with tons of equity and an ultra low interest rate and a mortgage payment that costs far less than an equivalent rent are going to lose their property and or sell it at a fire sale price. Like you have to have a mechanism for how that happens. And then whatever, the economy is going to be terrible. Rates are going to go to 20% and everyone's going to lose their job. We're going to have the worst bout of stagflation anyone has ever seen. And these out of work people, they won't have a choice. They're all going to be homeless. They're going to live in the streets. So you're like literally that is the picture that people are painting of how that happens. We showed the chart at the top of the show. For current buyers right now, debt to income is very, very high. For anyone that bought prior to January 1, 2022, debt to income is very, very manageable. They're sitting on a lot of equity. They're sitting on a very good interest rate. Home prices are sticky to the upside. Is that because they can't go down? No, it's because sellers are very hesitant to sell at a loss. And Jeb and I were talking about this earlier this week. We've talked about this on the show. I paid 21 years ago, $580,000 for my house. My house is worth close to 3 times that today. Does that mean if I can sell it for $600,000, I would be happy because I made money on the house? No. $1 less than whatever my house peaked at is a loss to me and any other homeowner. So what happens is, because they're very hesitant to take the loss, unless they are absolutely forced to sell through distress, they sit there and they camp out until such time as they can sell it for $1 more than what it was the peak. So there's just not a mechanism for forced sales that bring down the prices.
And let's talk about this, because this is a real life example. A property right now in Huntington Beach. I have a listing. It's not a distress sell in that the seller has to do anything. It's a distress sell in the fact that it just needs work. It needs, if you're going to buy it, you're going to have to rehab it, full remodel, in order to want to live in it. Which means, there's things on the property that creates issues with regards to financing. So it's a cash transaction. So I having a conversation with the client, and we talk about options. One option is for me to go out to investors that I know and pitch the property and see what they're willing to pay. And so in doing that, I told her, where I thought offers would come in. And I was pretty much spot on, because I realized what it was going to cost to rehab it, selling cost, and kind of the upside potential of where it would sell. And I have an idea of what investors are trying or are willing to make in this market in order to make a deal work. So we were right on. But I told her, I said, hey, listen, your goal is to get the most amount of money for the property. So what we can do instead is, instead of taking it to investors only that I know, which again is a small portion, but really good investors that have done a good job in the market, do good flips, that know what they're doing. And these aren't people that would buy if they didn't think there was an opportunity to do this in 3, 4, 5 months, depending on how long it takes them to rehab it. Bring it to the open market. Guess what? That pool of buyers has now doubled, tripled. My phone won't stop ringing for people that want that same opportunity. And people are willing to pay a little bit more on the open market and make a little bit less premium. Some think the upside is a little bit more. But what I'm getting at here is there's a good percentage of people out there that still see or looking at the market. And these aren't people that I'm telling, hey, this is going to happen. They're making their own references that because of low inventory, there's still an opportunity to fix a property, sell it up, because there's just a lack of it out there in the market, even with higher rates. And so with that, there's a ton of people still looking for opportunities out there in the market. And so as long as you still have that thing happening in the market, you have no recipe for any craziness on lower prices, right? This is, in theory, a purchase below the median home price here in Huntington Beach. It's a pretty safe spot to be. Now, if this were a $4 million flip, it'd be a different deal, but it's not. It's at $1 million. So the upside's 1.3, 1.25, 1.3 high side. People are willing to come into market and invest in that sort of thing. So that just shows you the amount of demand. I mean, I probably have 20 offers in my inbox of people that have cash ready to pounce on this thing today. I could put it under contract immediately if my seller were willing to accept an offer. But we're still kind of churning to see, is there somebody out there willing to offer a little bit more? Because every dollar matters to her. It's her retirement. It's her next purchase. Because again, she's not selling to go rent. She's selling to buy something downsized to another community. And it's one comes on the market, one comes off. Inventory doesn't grow in that situation. Anyway, Josh.
React to this one. One of our favorite viewers has an interesting point. Wesley says, I feel like Huntington Beach anecdotes should be taken with a grain of salt. That's prime real estate. So
that's fair.
There's an element of truth to it. I have some thoughts on this, but what I would say, first of all, we only know Southern California. like I know lots of parts of Southern California. I kind of know how they vary. And interestingly, Huntington Beach, probably like Long Beach would be the lowest end of the beach communities. But
In
Huntington Beach
Orange
is
County, Huntington Beach is the least expensive beach city in Orange County.
yeah. So it like I totally understand. We're not downplaying it going, hey, we live in a slum. It's a cool city. We both love it. Don't want to live anywhere else. But if you're from Corona Del Mar or Dana Point, like those people are like, oh, people
Yeah,
poor
they hate
people
this
up there
place.
in the dirty oil city. So you're right. It is much more expensive than inland stuff. But what I can say, having invested in both, price points are higher, but in general, both of them are fairly easy to move. Different buyers, different sets of buyers, but lots of demand, and it is relatively affordable. Like we're not talking about, I'm not trying to flip something in Corona Del Mar that is 3.75, that if I'm lucky, I'm buying it for 2.5 distressed, putting 500 into it and trying to sell for 3.5, 3.7. There is a limited set of buyers for that. Even at the higher price points, Huntington Beach has fairly high demand because it's not that truly premium real estate.
No, and again, Wesley, what you said is 100% accurate in my opinion. It is prime real estate, but that's important to note that real estate, again, we say it all the time, is local, right? What's happening here in Orange County, if you're in the Midwest right now and you're listening to this going, the homes are just sitting, nobody's buying them. Yeah, maybe, right? I mean, higher, maybe less job creation, less money there, less other things. Orange County is a bubble in the sense that there's a lot of money here. There's even in economic slowdowns, there's still a lot of money in Orange County. So there's still people doing things. But what I'm trying to get at here is that if investors thought that there would be a better opportunity, a lot of them would be waiting. That there wouldn't be 20 offers, 30 offers on a property. There would be maybe one, maybe none. If the idea that, hey, this is going to get worse, I'm going to just wait until they can't sell this thing. That's not the case.
And just so you know, the house that Jeb's talking about, we looked at it. We looked at buying it. I drove it. I don't love it. Like if you're in the street looking, you can see Beach Boulevard, the biggest street in all of Huntington Beach. You can see a big office building. If you look at the end of the street, you see a big condo complex rising up. That being said, it's really close to the beach. It's really close to everything in Huntington Beach, downtown, all the good stuff. So I can tell you good, I can tell you bad. And Jeb is telling you plenty of investors saying, yep, I like it. No problem. I'll fix it. And I'll have no problem finding a buyer.
Yeah, because there's absolutely no way they lose money. They might not make as much as they want, but they're not going to lose any. And that's really the key here. Nicole has a good question. It says, what income is used on the 1040 to qualify? I have a tiny business loss of $4,000 for my side business, but my main income is W-2. So just say what a 1040 is, Josh, just to explain it. And then let's talk about calculation.
It's your federal tax return. So there's two ways around this. If you don't own rental property or have someone self-employed on the file where we don't have to include the tax return, we generally don't need to show them the tax return. We're going to go pay stubs and W-2s. And for those of you out there saying mortgage fraud, you're not showing the true story. Fannie will ignore a small business loss if it is not your primary business. Now, if it was a $400,000 loss, we might have a problem, but a $4,000 loss, say we'll overlook it.
So how do we designate what is deemed a small business loss? Do they define that, or
it's in the guideline? But
so do you show them the 1040 and they just ignore it, or you just don't even show it?
If I don't have to show it, I'm not going to show it at all. Like I'm not required to. The guidelines are written that way. You don't have to show that. So we're not failing to disclose anything. We are gathering the documentation that we are required to and completing the loan application accurately.
Fair enough. All right. Let's see. So if you're at 538 here, you haven't done so already, hit the thumbs up. If you don't like or subscribe to the channel, consider doing that. It helps me reach my goal, trying to hit 100,000. My kids are more excited about this whole thing than I am, but really want to try to educate as many people as possible, and the likes and subscribes help me get there. So if you do that, I would be grateful. Let's see, Josh, this is a big thing going on out there because, again, there's this idea that assumable loans are very easy to come by, and you'll hear a lot of people pitching on them. And yes, they can happen. But Maria's asking, how can you assume a loan from a seller that already has a low interest rate? How does that work? will sellers and lenders are willing to accept and take over the mortgage. So basically what an assumable mortgage is somebody that has a loan, and when they agreed to the loan terms in the loan docs, there's essentially an addendum, so to speak. I forget what's it called, Josh. There's like it has a name, but anyway, there's something in there that shows that the loan is assumable in those documents. And typically when we talk about assumable loans, we're talking FHA loans are typically assumable. VA loans are typically assumable. Even if you're not a veteran, rather, you can assume as a non-veteran, a veteran's loan. And then you mentioned the other day, Josh, some adjustable rate loans, ARMs, are also assumable.
So why are fixed rate mortgages not assumable? And there is a carve out for that. Government loans, VA and FHA loans are both assumable. You do have to qualify. The current servicing lender is the one that has to process that. They're not set up or equipped to do it. There's no benefit in it for them to do it. So it will be slow and painful. And they're limited, I believe, to making $900 total is what they can charge for doing this. So FHA, VA fixed loans can be assumed. 99% of other fixed rate loans, including Fannie and Freddie loans, will have a due on sale clause. So you sell the house, you change the ownership, you cannot assume that financing. The loan is due and payable upon sale. Adjustable rates are different. And I wouldn't say that all adjustable rates are assumable, but the difference there is the lender hasn't committed themselves to an interest rate for 30 years and wants the out if the property changes hands. So with a variable, they're like, well, we made this loan, we'll keep it on the books because we're going to get whatever the market will bear at that point in time. The biggest impediment to assumable loans is that most homes are heavily appreciated. Unless someone bought in the last year, if someone bought at the beginning of 2021 or the beginning of 2022, when rates were still low, but we'd already seen the majority of the appreciation, maybe they only have a little bit of equity that you would need to pay them out for. But let's say they bought in 2020 and it's up 35%, $200,000 house goes to $300,000. They have an FHA or a VA loan. And yes, you, a non-veteran, can assume a VA loan if the seller is willing to leave their entitlement used up by you. But what would happen is you would have to come up with their equity to pay them out and or get a second mortgage that you would qualify for at the current market rate. And again, if a second is somewhere around 10% and that person has a 3% interest rate on the first, your blended rate between those two is going to be 6.5%, 7%. There's not a huge benefit or advantage to it in these highly appreciated homes if you could even do it. So are they happening? Yes, they are. I have a friend that has been on our Vetted VA Live show. She's a realtor up in Washington, and she has done 3 of these on VA loans. She specializes in working with veterans, and all of those were for a veteran PCSing in, so preliminary change of station. So being brought into the area and someone leaving the area. So they were veteran to veteran. So both of them sort of understood the process, hadn't owned the home a long time, wanted to work with one another. And I believe in all 3 of the situations, the person moving in had equity from a house that they were coming in. So they weren't trying to do zero down VA loans in that situation.
Yeah, but to get back, are there not the way how do you find these, right? You have to go look up people that have FHA VA loans. That's public record. There is software out there to be able to
Property
find
Radar.
Property Radar just did an episode with the founder of Property Radar this past week. Going to publish it probably next week. Some good information in there. We talk not really a lot about the software that he has, but he's been in the industry a long time, and just kind of what he's seeing right now, his thoughts on the market, where he thinks it's going, and then we talk about the idea of how things are likely to change on the home buyer front as a home buyer going forward. So stay tuned to that. It will come out, and I'll be sure to let you know. But hopefully that gives you all the info you need on assumable loans. So Josh, Miggy is asking, is there a loan for purchasing land and placing a mobile home on the land? And then in her case, she actually already owns the house, or I'm assuming the mobile home, maybe. Thoughts?
I would have to check into this situation. If you did not own, you were going to a dealer and you were buying a manufactured home, and you were going to a landowner and buying the land, there are construction loans that will allow you to make both of those acquisitions and have the manufactured installed on the property. If you are doing it with a property that you're buying the land, but you already own the manufactured, it complicates it. Manufactured is interesting in that nearly Fannie, Freddie, FHA, VA, they all allow manufactured, but many investors have overlays where they don't like it. So it severely limits the field. In terms of construction loans and rehab loans, we're already limited. Now, when we take it down to FHA, VA, limited even more. So there just aren't a whole heck of a lot of lenders. So in theory, I would think you can, but it may be a situation where it's going to be really hard to find a lender who will do it.
All right, there you go. This is a pretty easy one here. G-Man, I currently have a home, a paid off home. I do have VA eligibility to purchase another home. Can I purchase the VA home and have my daughter live in the home paying me the mortgage?
The key thing here is a VA loan has to be your primary home. You can have 2 VA loans. I have one going for a borrower right now. He's got a condo in Maryland. He's moving out here to California. He's buying a house VA. He doesn't have his full entitlement, so he's having to put a down payment on the property here in California, about 10%. But this situation where it's free and clear, you've paid off the other loan, you should have your full entitlement. You could do anything purchase wise, but it has to be owner occupied. Now, we've seen here in the comments, hey, how would the VA know? No one is going to do an occupancy inspection. No one's going to knock on the door and say who's living in the property. So home is paid, currently home paid off. Where do you live? Where is your job? It has to be logical and reasonable that you would live in this property and that you would move from your current residence to the new one. And then it comes down to you saying on that purchase agreement and certifying under penalty of perjury, I do intend to occupy this home as my primary residence within 30 days of closing. So the reality, do people do this and put a kid or someone else in there? Yes. So mechanically, there's nothing there keeping you from doing this VA wise, other than where is your income located and does it make sense that you're buying this home? And then what are you willing to do? Now, someone had pointed out, well, you only have to live in it for a portion of the year. It has to be your primary residence. You can't say I have 2 residences and I live here for 6 months out of the year. It has to be your primary. So more than half of the time, that is your primary home. That's where you file your tax returns from. But again, you get in the situation, once the loan is done, no one's coming back and saying, hey, let me see your tax return. Show me where you lived. Show me where you were. So it leaves a gray area where a lot of these things can and do happen, but per the guidelines, you can't do that.
All right, good stuff. I have a question here from Name saying, how can I add my baby mama to the house I already own so she can get it when I go bye-bye? So
who says she's going to outlive you?
Exactly. Don't let that happen, bro. No, in all seriousness. So basically you're just doing a quick claim deed and adding somebody to title. So quick claim? Yes.
Well,
Yeah,
so
claim,
let's
right?
just talk about the difference.
Yeah.
A quit claim says, if I have any interest in this property, I'm giving it to you. So I could quit claim.
Yeah,
I could quit claim Jeb's house over to you. I don't have any interest, so I'm not giving you anything. A grant deed says,
grant deed, there
I
we
do
go.
have an interest in this property and I'm giving it to you.
Yeah, yeah. So you do a grant deed, basically add them to title, and then you file it with the county recorder in your market, and essentially they're on title. So that's one way. The other way is that you could just have it in your name and you could have a trust or something else set up where when something happens to you, essentially the title of the property then gets handed to them. And then there's also something here in the state of California, I forget the name of the document, that you can actually sign it and file it with the county, where essentially it will transfer at closing, the trust and everything set up. But there are definitely options. I would say talk to, if you have an agent, your agent probably help you with this sort of thing. The title company that you dealt with, the escrow company that you dealt with might also help you in some regard, but there's ways out there to do this fairly easily and without really paying any money. My clients, this is something I do all the time. They just pay the money to get it recorded with the county. So it's not a big deal. Pretty easy to maneuver.
Jeb, I learned something related to this week that could be important to some of you. Most people who own with a spouse, or even someone who's not a spouse, will own as joint tenants. But with a spouse, you can also own as community property. Mm-hmm. If you and your spouse own as joint tenants, when we'll get a stepped up basis on that spouse's half of that property. If you own it as community property, apparently there is no half. So the entire thing gets that stepped up basis. So it is important to think about how you're holding title, whether it's trust, community property, joint
Say that
tenancy.
again. You froze when you said that. So I missed the first part of that whole thing. So joint tenants, if someone passes, is that what you said? You get the stepped up basis on their part.
On their
But
part.
if it's community property and they pass, the whole thing gets stepped
the
up.
whole thing gets a stepped up
Wow,
basis.
I didn't know that.
Yeah.
Interesting.
So like I've told you, we're getting ready to get a trust done and get mine moved into a trust. Right now, my wife and I are joint tenants. Need to get it probably.
They just live together.
Immediately.
They're just two tenants living together.
just
That's
two tenants.
Husband and wife, just two people. That's great. Josh, your internet sucks here. Anyway, just because I'm going to study the deed section of the real estate test tonight, just because Jeb Smith's there. I like that. Give me the Cliff's notes when you're done, so that I can pass my updated real estate exam. I think I still have 2 years. Last time I took it, and I was like, maybe this thing's expiring soon, so I had to go check it out. I've got some time, so I'm good there. Let's see, what do we got here, Josh? We got what do we got?
Here.
Okay.
One of your kinfolk has a good question when we finish this one.
Well, let's go with this one real quick. It says, how long should a home have been on the market before a buyer can credibly ask for a price drop? In this case, townhome just on the market, asking $100,000 more than next door, same square footage, sold 9 months ago. So I don't know that there's a reasonable amount of time, especially if a home is considerably overpriced. Now, you have to understand, it depends on where that price came from, right? Does the seller believe their home is worth X? Did the agent tell them their home was worth X? Because I'll tell you, in conversations with sellers, sometimes one of the conversations I ask sellers is, what do you think your home is worth? And I obviously have a number in mind, but I want to know what they think. And sometimes their number is higher than my number. And I'd say, listen, you're the seller. I will try to get you your number, but based on comparables, based on the market, this is where I think the price is. So we'll shoot for your price. And if your price doesn't happen, then we need to start talking about how to adjust that. And that is, I think, one of those things where if it's you as a buyer, have your agent call the other agent and say, hey, listen, where's this price coming from? Have the agent have the conversation, because, hey, look, we're looking at this comparable and this is where we're getting the numbers. And so in some cases, it could be that the property is nicer inside. There are things done. There are different upgrades or whatever that they feel like there's a premium there. It's just, you never know why somebody does what they do without asking. So I would start there. But a lot of times, in these situations, the seller has to be able to fill out the market and understand that they're not correct. Now, I will tell you, I just sold one here recently. We started at $1,475,000. When we listed it, I told them $1,425,000 was the price. We started at $1,475,000. Ended up closing at $1,400,000 almost 6 months later. Had we started at my price, it would have closed probably at the $1,425,000. It took them months to figure out that they weren't correct in that situation. So there's no easy answer, but rely on your agent. If you have a professional that's helping you, that person should be able to guide you through that process. So lean on your agent. If you need one anywhere nationwide, there's a link in the description below. So, Josh, did you have anything to add to that?
No, it's case by case. And like you said, there's a million different reasons. You had that property that you ended up selling it pretty close to the value. What was it on the market, 4 or 5 months? Just something lingering doesn't always mean.
So did I freeze on your side too, Josh?
We both frozen a couple of times.
We both froze. So somebody was Maggie, who is actually an agent here locally in Huntington, is asking me to repeat that. So I'm going to repeat it. If I'm repeating myself for you guys that heard it, I'm sorry, or maybe nobody heard it. But what I was saying is, I had a property here in Huntington Beach that my suggested list price was $1,425,000. They wanted to list it at $1,475,000 against my better judgment. I showed them the comps, whatever. They wanted to list it there. I agreed to do it, but said, hey, listen, if it doesn't sell, we're going to have conversations about reducing price. It took 5 months or so to get an offer. We ended up closing it at $1,400,000. Had we listed it at $1,425,000 to start, it would have sold probably at $1,425,000, maybe even a little bit higher. But because they waited, it took them forever to realize that they weren't correct in their pricing and actually adjust the price accordingly. And therefore, they suffered price-wise because of that. So depending on the seller on your side and who you're talking about, it might take, weeks, months for them to realize it, but use your agent, rely on your agent, and let them do the heavy lifting and try to provide you some context as to why things are happening. So hopefully that's clear and came across this time. Josh, we're at 5:55. What do you see?
This question, hopefully they're still here, wasn't as clear as I had hoped. What are your thoughts on renting and putting the home on the market? I know you have thoughts on that. We plan to move into a rental and then put our home on the market. We just sold our second home, and this will give us enough to pay cash. So S. Smith, if you're still here, I'm not understanding, if you're moving into a rental, what are you paying cash for? But just in general, Jeb, you've had some clients do this, thinking that they're timing the market. I'm not sure that's the question here, but what are your thoughts on someone going, hey, these prices are crazy, I'm going to sell and I'm going to go become a renter?
Well, I don't see that in this case, because they're saying that it'll give them enough cash to do something else. So in this case, they're selling homes to maybe go put that money into something else, is kind of how I'm reading it. I don't understand the first sentence, so I'm with you on that. But don't time the market. Don't try to time the market. Hey, listen, I am the perfect example. Right now, you guys, I made a video about it. It published Monday. Got a lot of people's feedback on that video, their thoughts. I asked for your thoughts on what I should do. I have a home right now I purchased in 2012. I have a 3% interest rate on it. I have a lot of equity in that house. I had somebody reach out to me for a property that we've always wanted, saying, hey, I'm ready to sell my home. My wife and I made the decision that that's the next home for us. That's where we want to be. I'm paying a higher price than what I'm selling my home for. I'm paying a much higher interest rate than what I currently have. That said, for us, it's the right move. It's, what do I preach about? What do Josh and I often talk about on the show? Buying when it's the right time in your life. For me, it's the right time. It's no better time than right now to do it. Unfortunately, rates suck. But if rates were lower, guess what? More demand, probably a higher price for the property. Other factors get in there that complicate the situation. So I'm in a situation where, you know what? It is what it is. I can ride it out. If rates go down, hopefully I'm in a position to be able to refinance and take a lower rate, and it improves my payment. But if not, that's what it is. And I'm going into it with the mindset that, hey, this is my payment. This is what I have to pay. I don't really have any answers from there. And it's not an easy decision, guys, but it is the decision that I'm making based on where I am and where my kids are and where we want to be long term. So that's it. That's all I got. That's all I got, Josh.
We've got one here we don't have an answer to, and then one that we do. G-Man, that's a really good question. I have a rental, currently set the rent at $1,200 a month, trying to Section 8 the home, but the state wants to settle for $1,100 a month. Any idea of contending these rent prices with the state is tough? Yeah, I do not know. I have a couple clients that have multiple rentals that they rent through Section 8, but I don't know if you can.
But here's the deal. The tenant can pay the difference, right? The tenant can pay the $100. And that's typically what happens on these, is that I know several people that own Section 8 properties, and Section 8 can't control what you lease the property for. They can control how much they're willing to pay for that tenant to lease it, is my understanding, right? And that the tenant can then come in with the difference. So Section 8 pays the $1,100, your tenant pays the additional $100, and life is good. Now, I could be wrong depending on where you're located, but my understanding is that is how it works, because this gentleman that I'm talking about has several tenants that pay above and beyond what Section 8 is willing to pay. So,
there was another one here, Jeb, that we can answer. It was a good one. So Robert says, what's the usual closing cost percentage from the purchase price in SoCal? So absent any discount points you're paying, you're fairly safe saying 1% for closing costs. title, escrow, appraisal, mortgage fees. And then if you're going to impound, you're going to have about another 1%, depending on the time of year. It could be a little higher, it could be a little bit less, but 2% should be fairly safe. If you're paying points to buy the rate down, it's going to be more. And then obviously the realtor fees, if you're a seller, you're going to have different closing costs than a buyer in terms of what they're paying on the mortgage side, because the seller gets the realtor fees.
There you go. Good. Josh, we're 6 o'clock. We'll go a couple minutes over here just to answer some additional questions. You answered that one. There's a lot on assumable loans, like a lot. And I don't know if it's because someone asked and then everybody else jumped on the bandwagon.
It's because no one likes the terrible rates we have to offer today. So
no,
they would like
fair.
to assume
I don't
time
either.
Machine rates.
Right. In this transaction that I'm doing, I confirmed, hey, look, dude, your loan's not assumable, right? Just, I know what kind of loan he has, or I thought I did, and I was correct. But just, hey, listen, I'm double checking as well, because that he had a 2.75. Like, I would love his rate. I mean, I'd pay him more money for the house at that rate because my payment would be lower. I mean, that's as much as we say we want the lower house price, we really want the lower payment, guys. And people will argue with me about this all the time, but I will tell you, if I give you the option, you take the lower payment every single time, especially when it's a considerable difference like right now.
And Jeb, the other reason why that question is coming up, we had the headlines all over about 10 days ago. These goofballs started a company. They got $1.5 million of venture capital to start a company. So that's real money. In venture terms, that's nothing. So they got nothing to start a company. Their publicist got out and got them PR that they're going to basically, from what I can tell, start a website that will help you find assumable properties, because there is
I can do that for free.
Do it for free. There is no third party fees in there to be made. There's no profit. There's no nothing in there. But it was all over the news, lots of headlines, and all the headlines say new company looks to help people get yesterday's interest rates. Ain't gonna
Josh,
happen.
Maybe the best comment of the night, and very, very good comment. Maria says you should do a podcast on assumable loans, and we 100% will. In fact, we might change our schedule to make this happen, because I do feel like it is the topic that we should be discussing at the moment because of where rates are. So, Josh, let's move that to the forefront and give these people what they want. I do. I think that's good. That's really good. Going back to a question I had a minute ago, though, I had this one on the screen. When selling a condo with old countertops and appliances, old equals ancient, makes sense to update in this market or let it go? I would tell you, how does the rest of the property look? If the rest of the property is redone, then probably makes sense to kind of keep it all in, cohesive and update it. If the rest of the property is outdated, I wouldn't do it. If you have old cabinets are going to be replaced, don't go put new countertops on them, because you're just going to waste your money, because somebody's going to come in and rip it out probably. Now, in the case that they're paintable and some other things, and maybe you're going to do some other work, maybe. But this is another reason to have a conversation with your agent. Your agent should be able to have these conversations and say, hey, do this, don't do this, or this is what I would suggest you do to help with the value. In other cases, it doesn't make sense. So, like for me, for example, putting my home on the market, I did some things that probably the buyer doesn't care about. And I know that. I mean, I tell sellers all the time, don't worry about that, because most people aren't going to pay attention to it. For me, it's things that I've been wanting to do anyway. And so I was like, you know what? I'll just have the paint touched up here. I'll have, this drywall corrected and just some things done, the screen fixed and other things, because it's my reputation, for one, as the homeowner, and I'm the listing agent. So I kind of have, just want the property to present well. So in that case, I did it. Was it necessary? Probably not. I'm not going to get any more money for the things I did. That if that's the answer that you're looking for. And Jane, yes, we're talking about Roam, ROAM. I believe that's the one that I saw anyway. Josh, it's 6:03. What should people do at this point if they haven't done it already?
Like and subscribe, thumbs up, slap the screen, high five.
Punch your screen. If you think Josh needs a different hat, a educated home buyer hat, I want you to punch the screen. And if you film a video of you doing that to me, I will send you one for free. If you put your fist through your screen, I will happily send you a hat and a shirt. Both.
Your screen will cost more to replace than the hat.
Hey,
and the
listen,
shirt,
maybe
you'll
you have an old
make
screen
Jeb's
and
day.
maybe you were going to replace it. And this is an opportunity to get something free on something you were already going to replace anyway. I don't know.
She's going to punch your
Josh,
side of the screen, Jeb.
what's that?
She's going to punch your side of the screen, not mine.
Hey, listen, we didn't say which side. Right in the middle is preferred. But anyway, no, guys, 6:04. Been here an hour. Appreciate you being here. Honestly, it sounds like it's Groundhog Day. Every week we talk about the same things, but a lot of you guys still show up, and for that I'm grateful. There's some new names, some new faces in the chat, and always like seeing those. But if you are a new face or an old face and you haven't liked and subscribed, we appreciate that. Go check out the Old Educated Homebuyer podcast, the channel. I don't think anybody's buying homes, but if you are buying a home and need a mortgage, you want a pre-approval, talk to Josh here on the West Coast. I'll put a link here. Scroll in the bottom where you can get in touch with Josh. If you need a lender, real estate agent, out of state, investment property, primary, whatever, check that link and it'll get you in touch with somebody there. Josh, I will leave you with the final goodbye this evening.
We're living in interesting times. So Jeb and I are learning along with you. So tune in every week and you will hear the conversation, a summary of the conversations that Jeb and I have had from the preceding 7 days. And also tune in next week to find out if the projections for PCE on Friday were accurate and if they made any difference in what's happening with mortgage rates.
Yeah, just again, buy when it's the right time in your life, have money in the bank, be comfortable with the payment. Even if you don't like it, as long as you're comfortable with it, that's what's important, and have a longer term time horizon. Goes back to buying wise, borrowing smart,
right.
Building wealth. Buy wise. You know, that's the name of the company.
Let's
Buy
do it.
wise.
Let's
So buy
do it.
wise. So, but anyway, we appreciate you being here. Until next time, guys. Au revoir.